Now, if we look at the supply now of loanable funds, if we turn our attention to not the people who want money, but people who want to give money and make it available. Well, we give money based on the expected rate of return. And when we step back and we start saying, I want to put my money in investments to make money, to make interest, usually I'll go out and measure the expected rate of return. This could be in interest payments, this could be in capital gains, and a lot of things. I'll also measure the risk of an investment. There are several types of risk. Default risk, for example, I could give my money to a company, and the company may fail, and that's what's called default risk. I could also have what's called interest rate risk. Interest rates may go up and down. If I invest my money at a low interest rate and then interest rates rise, for example, I could have maybe made a better investment. So there's risk involved there as well, and also inflation risk that's linked to that as well. Lastly, liquidity. Now, liquidity is based on the how quickly I can transform my investment to cash. Some types of investments are more liquid than others. So again, you want to invest your money, you want to make more money with your money. These are the three things you looked at: the rate of return that you expect, the risk of the different ways to invest your money, and the liquidity, how quickly you can transform your investment into cash. If you invest in stocks, if you want to transform that into cash, you have to have somebody buy your stock. If you invest in, let's say, paintings, you have to sell your painting. If you invest in a house, you have to sell the house to transform into liquidity. So we often compare risk, return, and liquidity of different investments. Banks offer a lot of products for households to attract your money so they can then loan the money out to businesses, for example. You can put your money in a checking account. In French, we call that a compte courant. This is the most liquid type of account you can have. You can have your money back whenever you want it. It's got a guarantee on it. Savings accounts, or what's called a compte sur livret in French, which make a very small interest rate. Banking products that are offered are also debit cards. This is a way to access your checking account. And banks offer also what's called a compte à terme, or certificate of deposit, where I'll give money to a bank and I will receive a nicer rate of interest, but I usually am prohibited from using the money or withdrawing the money early. I must leave it there for a certain amount of time, and if I try to access my money, or if I want my money back, I pay a penalty. Now, this is why it pays a higher rate of interest, because I'm giving them my money and I'm guaranteeing them that I won't ask for my money back. Interest rates in Europe have been falling drastically, so if you invest your money in a bank, in a savings account, you make very, very, very low rates of interest today, less than 2%. It's very, very, very small, 1% interest rate. Bonds, if you invest your money in a bond issued by a company, for example, so you're giving them money in exchange for a piece of paper and a promise to give you a certain amount of interest, usually the interest rate for bonds is higher than a savings account, because there's more risk involved, obviously, here. So we have a risk premium, and we're giving money for a longer period of time. If you give money, if a company gives you a piece of paper and says, okay, give us some money and we'll give you your money back maybe in 10 years. Well, if inflation rises and the interest rate they pay you was very small, you're going to start losing money. So because there's a risk of inflation, they will probably give you a higher rate of interest in the beginning. So a bond is basically a piece of paper. McDonald's, corporations issued bonds years ago. It has a face value. So this is a $5,000 bond, or 5,000 euro bond. And what it is I give $5,000 to McDonald's. McDonald's says we'll give you back your money in 10 years' time when it's reached its maturity, and we'll give you what's called these coupons with your bond, and these are the interest that your money will earn when you invest in it. Okay, so how does a bond work? So let's take this example apart. Here we have a 5,000 euro bond. Okay, it pays 5% over 10 years. So every year, the holder of this bond can take the coupon, rip it off, and get back 250 euros. That's the annual rate of interest. Okay, so I'm getting 5% of 5,250 every year for 10 years, and little bit by little bit I take these coupons off and I exchange them. I give them back to the owner and say, okay, give me my 250 euros. Year 1, year 2, year 3, year 4, year 5. Now what's interesting is that a bond can be sold to somebody else. I own this piece of paper that says it's worth 5,000 euros in year 10, and I have 2 little coupons sitting on it, and I can go to somebody and sell this. So here I've got my bond. I have a 5,000 euro bond that matures in 2 years. There's 2 coupons left. The coupon rate is 5%. The coupon rate is indicated on the bond. It doesn't change. And there are 2 coupons left of 250. So if I sell this to somebody, they have these 2 coupons, and they're going to get 5,000 in 2 years. There's 2 years left. They'll get 250 in 1 year, 250 in the second year, and they'll get back this big coupon on the top, let's say 5,000 euros. And I ask somebody, well, how much will you pay me for it? How much are you ready to pay for it? And the interest rate today in the market is 5%. So the individual does a little calculation. Let's see, I can currently invest my money at 5% in the marketplace. You promised me 250 for this first coupon in 1 year, and another coupon in 2 years, plus this big coupon, what it's initially worth, a face value of 5,000. So what do I get? Well, I'm going to get 5,250 in 2 years. I'm going to get the big coupon and the last coupon, 5,250 euros in 2 years' time. That, at a rate of 5%, is equal to 5,000 going back present value 1 year, and going back another year in present value is worth 4,761. And I have my first coupon here that I'm going to get in 1 year, and the present value is 239. And you can see if I add these up, I'll give you 5,000 euros for your 5,000 euro bond. Now, what happens if interest rates change in the marketplace? This is where it gets interesting. Imagine interest rates drop to 2%. So I have the same bond, and I want to sell it to somebody. It's 5,000 euro face value. The coupon rate is 5%, and there's 2 coupons of 250 euros left. And I want to sell this to somebody, and they're going to do the same calculation. They're going to say, okay, in 2 years I have this big coupon I can exchange for 5,000 euros, and I have the little coupon in 2 years for 250 euros, so 5,250 euros in 2 years. The present value of that in 1 year at 2% interest rate, because that's the market rate, is 5,148, and the present value of 5,148 today is 5,047. And I have my first coupon, which is worth 250, which I'll be able to exchange in 1 year. So I get 250, but the present value of 250 at 2% is 245. And if I take the sum of these two numbers, it's pretty obvious. I come up with 5,292, quite a larger value. The price of the bond, what I'm ready to pay for this, has increased. Why? Because the bond is offering me 5%, but the market interest rate is 2%. So I'm going to want to get my hands on this bond instead of investing at 2% in the marketplace. And the price is 5,292. So if you think interest rates will fall in the future, buy bonds today because you could sell them at a higher price in the future. Now, stocks can be bought and sold in markets today. We have many markets that exist. We have the New York Stock Exchange, the NASDAQ, the Tokyo, the Shanghai. There's many different markets where you can buy and sell stock that have been issued much further in the past, and you're buying from a second buyer or a third buyer that owns this stock. You can look at the performance of the stock market by following Dow Jones averages. This would be the 30 largest U.S. companies, the value of their stock, the S&P 500, Standard & Poor's, the 40 most important of top 100 market capitalization firms in France, the CAC 40, the FTSE 100. All of these are indexes that give you an idea of the price of the shares of a lot of the firms combined into one number. Okay, and if we look at the rates of return, if you invest, for example, in the stock market and you let the price of the stock rise over time, right? The Euronext over a 10-year period. So if I buy stock today and I sell it in 10 years, you will typically make about a 15% rate of return, and the Dow Jones about 13%. And this is even accounting for some major dips. Now, lately we have a big dip because of the coronavirus. We'll see what the 10-year rate of return is, but typically we will see that the market should recover over a 10-year period of time. Now, this is a risky investment, right? Because the price of the stock can go up and down, up and down, up and down, and you definitely don't want to sell when it's down. A lot of variability, and it's a long time without your money. But over the long period, stock investing is a very, very wise thing to do. If we look at another way we can invest our money in stocks, imagine you don't want to buy a particular stock, but you'd like to invest in a lot of companies. Well, one way to do this is with a mutual fund. A mutual fund is, let's say, a basket of stocks. So I have a bunch of companies, maybe 100 companies, and I put all of their stock into one basket, and then I put a price on that basket, but I divide up the value of those stocks into smaller parts. So I sell parts of this basket to you as an investor. It's a way to diversify. Instead of buying all the stocks in all these companies, I just buy one share of what's called a mutual fund. And this helps me to minimize my risk. And you can buy these through banks, but also through investment houses like Fidelity. So if I go to the Fidelity Environment Fund, you can see that the money that's in that fund is invested in numerous companies. Okay, these are all the companies, and the percentage of the investment in this fund that is given to Honeywell, Danaher, whatever. These are the ownerships of the fund in these different companies. And when you buy one share of this fund, you're buying a fraction of a little bit of all of these companies. And that's a way to diversify your risk in your portfolio. You can also invest your money in real estate, intangibles, housing, art, precious metals are ways to invest your money if you like that. And I said, as again, risk and return are very important. Your checking account, low risk, yep, very little risk in your checking account, but very, very low return, but very high liquidity. If we move on to a certificate of deposit, low to medium rate of return, very little risk, but medium liquidity. So we see an exchange, a little bit more return for a little bit less liquidity because you can't touch your money for a long period of time. A stock, the return can be very high, as I said, 13, 15%, even higher, but it's extremely risky, and medium liquidity. I need a seller and a buyer to come together if I want to get rid of my stock. I own stock in a company. If I want to sell it tomorrow, there's got to be somebody that wants to buy. If nobody wants to buy, I cannot sell it. And then we have things like gold and collectibles. For example, I can buy artwork. The return may be medium or low. There's high risk and very low liquidity. I've got to find a buyer, again, if I want to sell a piece of artwork as an investment. How do you get rich? Good question. Basically, it's tough to second guess the marketplace, especially if you invest in the stock market. The stock market follows what's called a random walk with a trend. So it's a basic trend line, and you've seen this in the diagrams before, but it goes up and down and up and down. And it's very hard to second guess the market. You can't say, okay, I'll invest my money 1 year and I think the stock market's going to go up. Well, it probably won't. And it's very hard to really understand where this is going to go. So how do you invest your money? If you invest in a portfolio of stocks and interest-bearing accounts, you can expect around 7% in the long run. So if you're investing in a good portfolio, you can expect that. So assume we start investing at 7%. Imagine you start saving your money and you're 25 years old and you save, let's say, 3,000 euros per year, every year for 25 years. And you retire at 65, which would be 40 years of doing this. So you're putting away 250 euros per month, every month for 25 years. At the end of 40 years, you will have saved and earned interest, and through your portfolio of stocks, it's making 7%. You will have accumulated 656,000 euros for your retirement. It's recommended in how I buy, or how you would want to buy stock, to invest a fixed amount every month. So imagine you try to buy when it's low, a stock, and you sell when it's high, and this is tough to do. You're constantly tracking the market. So what you can do is you can say, well, I'll buy 100 euros worth of stock, of General Electric, for example, every month. So you fix the amount that you will invest, and you spend that month every month. Now, let's see what happens. This is the actual price of GE shares from June 1st to December 1st. And we can see that the prices were around 11, then they dropped really low, and they went back up. Well, if you invest a fixed sum of money every month, you can see that you buy more shares when the price is low, and you buy fewer shares when the price is high, which is exactly what you want to do. So just fix an amount and buy shares for that amount every month. It's a wise investment tip. Also, when you look at a portfolio of stocks, you can have a conservative portfolio, which is investing primarily in fixed income, so dividend yielding stocks, companies that are not risky, so hardly any small capitalization, small companies here. A lot of large cap type of firms. Okay, you can also have a more aggressive stance here, and here we have no fixed income. Okay, so no yield, and a lot. Here we have small cap type of firms and investment. So there's different types of portfolios that exist. Overall, as an individual, when you invest money, you want to maintain a relationship between equity investment, so this is stock investment, which could be very high risk, and what's called cash or interest type of income investments, so that you're earning a given interest or savings type of, or safe, high liquid investments, maybe low interest bearing, but mostly a fixed income, something coming to you every month or every year in the form of interest payments. So the typical trick to invest money is you take your age and you subtract it from 100. And the number you come up with should be the amount that you invest in the stock market. So it's a higher rate of return, but a higher risk. So if you're 30 years old, that would mean that you should be investing about 70% of your money that you have to invest in stock and about 30% in cash equivalents or income-bearing investments. If, however, you're 60 years old, you're going to be doing the exact opposite. You're going to be about 40% in stock and 60% in less risky investment. Why? Because as you get older, you're going to need your money. You don't have much longer to live. You don't have a stable income flow possibly, and you can't take the risk, obviously, of investing your money in risky stock market investments. Okay, so with that, we've covered the basics of the financial markets. I hope you got some pointers on how financial market